Rich, John Najarian, his wife, everybody from Rick Reeder to Marko Kolanovic to Tom Lee are bullish. And they're not just a little bullish, they're pretty bullish.
Yeah, and they're bullish, Scott, because, of course, the Fed has said that they are going to let inflation run. They're going to not just cut it off as soon as they start to see it rear its head, which it has, of course, but they're going to let it run. And so if they had been more hawkish on inflation and said we will likely hit this and hit it hard because we've thrown so many trillions at the market already, then I think you wouldn't see those four people that you just named as bulled up as they are. But because they're going to let it run, Scott, yeah, that's great for asset prices. We all know there's somebody to pay down the line. But to Josh's point, as far as these midterms and so forth, that is going to mitigate some of the, I'll call it progressive agenda, that as far as the spending, it probably won't be as large. Taxing, I don't even know if they pass anything on taxing. I mean, they barely got the $28 billion in on cryptocurrencies, and I don't think that'll even make the House bill. So I don't think that'll be part of the law as it ultimately passes and goes up to the president. So I think overall, Judge, yeah, I don't need to be terribly bulled up, but I certainly am thinking that we're going to see asset prices continuing to rise, not at a dizzying pace, because it's all about velocity, volatility, and volume, but at a regulated pace. And I think that's what the market wants to see.
Okay. Speaking of volatility, that brings me to our resident foil. I mean, Steve Weiss, who says it's not all in time. It's not going to be an everything rally like some are predicting, Steve?
Yeah, well, look, you can call me foil. I can call me the voice of reason and an outside, the consensus thinker. And that's how I like to think of it. First of all, we don't need strategists. I mean, look, you got to be a real fool to say the market's not going up when it goes up 90% of the time. How difficult a job is that?
Hey, there's one. Come on now.
So you're invested.
I know you like to throw bombs around, you feel better about yourself and all that, but come on. I mean, there's a difference between saying the market's going to go up and saying, well, I think the environment is pretty well set that between now and the end of the year, you can have maybe a more substantial rally than some are thinking. I think that's a fair way of characterizing the way that the Tom Lees of the world, who've come on here and defended their positions on a regular basis, can say things without just being all just bulled up.
First of all, I think you misunderstand my intentions. My intention is to make you feel better so you can spend more time reading self-help books than reading strategist reports. So in terms of the market, here's what I see. I see everybody being very positive on the market. And to me, that's a time for caution. And here's where the caution is. I'm not saying don't be invested. I'm saying what I've been saying, which is go to quality. Concentrate your portfolio. A concentrated portfolio generates greater returns than a diversified portfolio. And you got to be concentrated in quality names, because what's happening is, and if people don't see this, they've got their heads in the sand, it's a coordinated effort by Powell to go earlier than they've been saying in terms of cutting back on the buying. Now, this is perfect. I'll tell you why it's perfect. And what I see is that normally you have a handoff from monetary stimulus to fiscal stimulus, which means government stimulus, political stimulus. Now you've got a handoff to private sector stimulus because they're so flush with cash, they're raising wages, so you don't need full employment to get wages raised. I do believe that inflation is transitory, but we want rollback wages. You've had Japan, which has had free money forever, which can't get their inflation to a reasonable rate, can't get their economy to grow. So once the pandemic's more in hand, and maybe it's not for 6 months, maybe it's not for a year, we'll go back to what we were, with technology bringing down costs, with innovation bringing down costs. So I think that the market's going to be very rocky, as I do believe that rates have bottomed for the year. Sure, we may go a little lower, but they'll march up. And it's not getting to 1.6 at the end of the year. It's the direction and the velocity of the direction that's going to cause a bumpy market. There are no other catalysts out there. We're through earnings. We're through what's happened in Congress. Josh makes a great point. Let me take the next conclusion. If you have a divided Congress, a divided government, nothing gets done. I do not believe that Biden gets that ridiculous $3.5 trillion package done. So, yes, the environment's very good, but it's going to be rocky because nothing goes up in a straight line, and rates will be the cause of the rockiness.